What's up everyone, it's Scotty with MoneyVest. So in this video, wanted to go over what Loretta Mester talked about with respect to interest rates, what JP Morgan's strategist also mentioned, and that was word for word what I have talked about in our previous videos. It is just mind-boggling. Sometimes it makes me feel like these people may be watching the videos because it was word for word what I have talked about in my previous videos. So hope you guys enjoyed. We're going to give you a little bit of a round out on the interest rate expectations from the markets and also go over the current state of the stock market with respect to how well we are doing in 2023 and what sectors and what parts of the markets are really doing well versus which ones aren't moving at all. So hope you guys enjoyed this video, find it helpful. If you do, make sure that you drop a like. All I ask in return is that you drop a like and of course subscribe to the channel if you're just joining us for the first time, and link to our Discord and Patreon is going to be down below. The first week of the month is the best time to join, and there are a few more spots available if you want to get access to all the buy and sell alerts, options alerts, trade ideas. Everything is going to be included with the link down below, and we'd love to have you on board. So this right here was something that I have mentioned before with respect to rate cuts, which we will come back to towards the end of the video so I can explain more. But Loretta Mester basically sees that Federal Reserve may need to raise interest rates once more this year. Now I want to point out that she is a non-voting member in the committee this year. So whatever she says has no bearing on the expectations for interest rates because she's not going to be able to vote. But of course, it could sway other Federal Reserve members as well. And we know from the dot plot that right now 12 members do favor a higher interest rate, one more rate hike in 2023 versus 7 that don't, that actually expect interest rates to be where they are. So the president of Cleveland Federal Reserve said Monday that she suspects the central bank may well need to raise interest rates once more this year and to keep rates higher for longer for some time to get inflation fully under control. Now, there are very specific things that I want to go over and talk about. First thing, inflation remaining too high. Why is she saying that? Because she expects gas prices to be a big of a problem because oil prices have been rising, and that could threaten to stall further progress in lowering inflation. And as a result, as oil prices rise, as gas prices at the pump increases, that's going to affect the inflation expectations. See, a lot of the times inflation itself is very much, driven by expectations, right? Because if you expect inflation to be higher in the future, well, guess what? You're going to spend today and you're going to forego future spending. And if a lot of people start thinking like that, well, guess what? Everyone starts spending today and inflation indeed ends up higher because of all that influx of demand and that spending. Now, if you expect inflation to be lower, in other words, prices to be lower in the future, well, guess what? You're going to wait patiently for when the prices are cheaper. And when everyone starts thinking like that, there is no demand, there's no spending, and prices are indeed lower. So a lot of the times inflation is driven by inflation expectations. And that's why Jerome Powell has also mentioned that, look, we want to get inflation expectations down to 2%, 1%, because if higher inflation expectations are embedded among people and consumers, that's a problem because that will eventually drive inflation higher as well. So main goal here is to control expectations, not so much the inflation itself, because it'll take care of itself if you control expectations. Now, going over to what she says if so, higher inflation could become embedded in people's view of the economy and affect their behavior in ways inconsistent with price stability. And she also mentioned that the Federal Reserve is trying to avoid raising interest rates so high that a recession follows, but that's been a usual outcome since World War II every time the central bank has begun rate rising cycles. So here's another thing, right? Every time the Federal Reserve has raised interest rates, something has eventually broken. We've talked about this in our previous videos. I've pretty much brought over jobless claims, talked about unemployment rate, talked about GDP, talked about money supply, talked about, just economic conditions in general. Every time the Federal Reserve has raised interest rates and has embarked on this tightening cycle, something has given up. Something has given its way, right? Something has broken, so to speak, in a more brutal and precise manner. And of course, we also learned from Michael Barr on Monday, who said the most important question at this point isn't whether Federal Reserve is going to see another interest rate hike, but rather how long is it going to stay at these restrictive levels, right? That's another really important piece because it's not so much about whether we're going to see another rate hike, because to tell you the truth, we're already at over 500 basis points, right? So 25 basis points up or down isn't going to do anything, right? It's seriously not going to affect the market or the economy all that much. Under 25 basis points literally is not going to do anything because we've already gone through such a significant amount of tightening. What is going to matter now is how long do we stay at these levels? Because like I said in my previous statement, eventually there is a possibility, and it probably only increases with time, that something breaks, because higher yields, higher interest rates, I mean, people are paying 7-8% on their mortgages, the people that are borrowing mortgages now, auto loans, credit cards, all types of borrowing cost has surpassed, levels that we haven't seen in several years, let alone decades, right? I mean, the yields are sitting at over October 2007 highs. That's 16-year, 17-year highs at over 4.5%, close to 5%. So borrowing cost is extremely high in the United States. And that can go on for a few months, maybe a few quarters, but that will certainly not play out over the next 1 year, 2 years. And again, without something breaking, right? Because people are going to start paying more, that they're going to deplete their excess savings. And of course, that's going to potentially, again, not saying that it will, potentially create a financial disaster in the economy. That's exactly what JP Morgan also mentioned, that eventually something will break, and bond yields could unleash a financial accident in the economy. And this is word for word what I have mentioned. They mentioned that not to worry, bond bulls, if yields continue to climb, eventually the Federal Reserve will likely be forced to cut rates. However, he offered a clarification that it would be foolish to expect the central bank to lower borrowing costs unless it has a specific motivation to do so. Does that ring a bell? Because it should. I have specifically talked about this phenomenon of having an incentive. The Federal Reserve will not cut rates unless it has an incentive to do so, right? Every move the Federal Reserve makes, whether it's to the upside or the downside, it needs to justify. And if the two things don't line up, if there is inflation not down to the Fed's target, or there is a recession in the U.S. economy, the Federal Reserve is going to have a very hard time explaining rate cuts, right? Because if inflation, they've reiterated, right? They've dug themselves a hole to a point where they've pretty much every meeting, they've mentioned that our goal and our objective is to get inflation down to 2%. 2%, 2%, 2%. That's what they have mentioned. They've dug themselves a hole of 2%. If it's not down to 2% or lower, they're going to have to really bring up with some good reasoning as to why they're cutting rates. And that's the motivation. That's the incentive factor that's involved with cutting rates. They're not just going to wake up one day and cut rates. That's what I've mentioned before, and it's kind of crazy that they're pretty much mentioning that, right? It'd be foolish to expect central banks to lower borrowing costs unless it has a specific motivation to do so. And where is that motivation going to come from? Well, that motivation could be a recession. That motivation could be increasing jobless claims, which Jeremy Siegel also mentioned as a leading indicator for unemployment. That motivation could be lower inflation. That motivation could be political. That motivation could be a financial crisis or an accident. There could be a bunch of different incentives, but we need to see something in order for the Federal Reserve to justify cutting rates. Now, although stocks slumped during September with S&P 500 booking its worst monthly performance for the year, the analyst added that, but it seems like the equity market still has the idea the Federal Reserve is going to ease for the easing's sake in 2024, and I just can't get there. Meaning, the market is expecting the Federal Reserve is going to cut rates just for the sake of it, which obviously may not happen if we don't see any of these outcomes play out. JP Morgan's Jamie Dimon also warned that interest rates could go to 7%. That obviously is a crazy number, 7%. I don't even know how the economy may function at 7%. We haven't seen those levels, and of course the amount of debt has increased substantially since 1970s and 1980s. And the current move in the bond yields, even as cyclicals are selling off, could be seen as a sign that the market is starting to price in a policy mistake, that potentially the Fed is going too far, and that higher for longer will deliver pain. Given this, we do not think the bond yields will be able to keep moving up for too much longer and will ultimately fall. And that obviously creates a very nice opportunity from a bond trade perspective, which I've already done videos on as well. So guys and girls, there's a lot of opportunity kind of creating itself here in the market, especially when it comes to the bond market. But we have to be patient because, look, the Federal Reserve doesn't want to create another situation of the 1970s and 1980s. What happened back then is that as soon as they took their foot off the gas, inflation skyrocketed once again. And we had a double dip recession. We had a double top inflation, and it went back up to over double digits. That's really what the Federal Reserve is trying to avoid. They don't want to see inflation at higher levels once again, right? And for that, to make sure that doesn't happen, they have to be aggressive. They have to literally just keep going so that inflation comes down below 2% and stays there, right? It stays there. And that's the key word here as well, right? Just because inflation comes out under 2% isn't going to cut it. It needs to stay there, and inflation expectations need to come down so that they don't risk another situation of high inflation once again. And until they see that, right, either that or a very, very severe recession, which will take care of inflation by itself, because in a recession, people start to, just save and not spend anymore. People start losing jobs, so people are not spending anyway. So inflation takes care of itself during a recession. So it needs to happen before the Federal Reserve starts thinking about cutting rates. So hope you guys kind of get a good sense of what we're talking about. And these are some of the reasons or the potential incentives, right? Motivations or motivators, if you want to call it, that the Federal Reserve may look at in order to cut rates. And that's going to be, of course, jobless claims. If that starts going higher, that's a leading indicator for unemployment. Jeremy Siegel mentioned that in one of the reports, and I broke it down earlier today. Unemployed persons, if that starts going higher, that's going to feed into the unemployment rate. If the GDP starts contracting and we start seeing negative growth and, it starts to really slow down, or if core inflation is under 2%, right, and stays there, that's probably going to be the most important indicator for them, the most important incentive or motivator in order for us to see rate cuts. And of course, crisis, if there's any accident, financial crisis, God forbid something happens, that's going to be another potential incentive for the Federal Reserve to cut rates. But this may not play out as well, because we already learned from the banking crisis, they didn't even flinch, right? They didn't even flinch. They still went on and to raise rates. And there might be some aspect of political pressure in 2024. So these are some of the reasons that some of the motivators that I'm really watching and tracking closely to better understand, what could be the timeline of those rate cuts. Because look, the higher for longer narrative is eventually going to have more and more strain and more pressure on the economy. Believe it or not, but we've looked through the data, we've looked through the historical numbers and statistics. Higher for longer interest rates at over 5, 6, 7% is going to affect the economy. Sooner or later, it will, right? It's just a matter of time at this point. I mean, we just have to kind of wait and see how the next couple of quarters play out. But sooner or later, there is a possibility and a higher likelihood that it does affect the economy. And then that's going to be the real question. How does the Federal Reserve respond with that type of, pressure on the economy and that strain where jobless claims start going higher, economic weakness starts to show up. And at that point, you better hope that core inflation is under 2%, because if it's not, the Federal Reserve is going to be in a very, very hard place. They're going to be somewhere between a rock and a hard place, because you've got high levels of inflation, not near their target of 2%, and you've got an economy or unemployment or a market that's actually starting to show signs of weakness. So do they cut? Do they raise? Do they stay where they are? That's going to be the dilemma. So I hope you guys enjoyed this video and found it helpful. In all of this noise and this chaos, I just wanted to dissect all the data that's available to us, but help you also understand that, look, any type of deals that represent in the market that come into our, come in our way, take advantage, right? Take advantage, because it is going to be a rarity for the markets to be down another 20% from these levels, or 20%, 25% from their all-time highs. So it's, you don't see that very often. So what I'm doing is I'm starting to buy, right? Even from a bond trade perspective, I mentioned that I've got a buy limit order in our Discord for TMF at a specific price. I also did buy some semiconductor stocks. I bought some ETFs. So I am dollar cost averaging. It's not like I'm sitting on my hands just waiting for everything to play out. I am dollar cost averaging and putting money to work. And, I've got lots of dry powder right now, 24, 25% still sitting on cash, and we'll be looking for buying opportunities. So again, if you want to get access to all those alerts and find out exactly what I'm, buying in the markets, link's going to be down below. As always, if you enjoyed this video, found it helpful, make sure that you drop a like, subscribe to the channel. And again, link to our Discord, Patreon is down below. First week of the month is the best time to join. Happy investing, and I'll see you all in the next video.